Welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for MetaTrader 5 and study how they actually work, line by line. In today's session, we're looking at a strategy called Z-score mean reversion. It's a counter-trend approach built around a simple statistical idea. Price tends to drift away from its average and then snap back. To measure that stretch, it uses a Z-score together with a moving average and the relative strength index. By the end of this video, you'll understand exactly how it reads the market, how it enters, and how it manages risk. Let's dive in. So what exactly does this expert advisor do? At its heart, Z-score mean reversion is a mean reversion strategy. That means it doesn't try to chase a trend. Instead, it waits for price to become stretched unusually far from what it treats as fair value, and then it looks to fade that move, positioning for a return back toward the average. The fair value here is a simple moving average, by default over 20 bars. The strategy then measures how far the current close sits from that average, but it doesn't measure that distance in raw price. It measures it in standard deviations, and that measurement is called a Z-score. A Z-score of 2 means price is 2 standard deviations away from its mean, which is statistically a fairly extreme stretch. By default, the strategy becomes interested once the absolute Z-score reaches 2. But distance alone isn't enough. The strategy layers on several confirmation filters to avoid acting on every stretch. It uses the relative strength index to confirm that momentum is genuinely exhausted. It checks that the market is in a flat, range-like regime rather than a strong trend, because trends can stay stretched for a long time. And it waits for the most recent candle to actually begin turning back toward the mean before committing. Risk is handled mechanically. Every trade is placed with a stop loss and a take profit derived from the average true range, so position risk adapts to current volatility. There's also a break-even mechanism and a time-based exit. Who is this style suited to? Educationally speaking, it's an example aimed at range-bound conditions and at traders who are curious about statistical, counter-trend logic rather than momentum chasing. As always, this is shared for learning, and it is not a recommendation. Let's walk through the full logic step by step, exactly as the code executes it. The strategy works on completed bars only, so it evaluates its rules once per bar rather than on every tick. First, it builds its core measurements. It calculates the moving average, which it treats as the mean or fair value. It calculates the standard deviation of recent closes. And from those two, it derives the Z-score, which is simply the current close minus the mean, divided by the standard deviation. Alongside that, it reads the relative strength index and the average true range. Before it will consider any trade, it applies a regime filter. It compares the current mean with the mean from several bars ago. If the difference between them is small relative to the average true range, the market is considered flat or range-bound. If the mean is sloping strongly, the strategy stands aside entirely. This is the flat regime gate, and its job is to keep the strategy fading inside ranges and out of strong trends. Now the entry conditions. For a long, 3 things must line up together. The Z-score must be at or below the negative threshold, meaning price is stretched well below the mean. The relative strength index must be below its oversold level, confirming downside exhaustion. And the current close must be higher than the previous close, showing price is already turning back up. Only when all 3 agree does the strategy signal a buy. The short side is a mirror image. The Z-score must be at or above the positive threshold, with price stretched well above the mean. The relative strength index must be above its overbought level, and the current close must be lower than the previous close, showing price beginning to turn back down. When all 3 align, the strategy signals a sell. On entry, risk is defined immediately. The stop loss is placed at a multiple of the average true range away from entry, 1.5 times by default. The take profit is placed at a larger multiple, 2 times the average true range, giving a reward-to-risk ratio of roughly 1.3 to 1. While a trade is open, 2 management rules apply. Once price has moved in favor by 1 average true range, the stop is moved to the entry price, a break-even adjustment that reduces exposure. And if the trade hasn't resolved within a set number of bars, 30 by default, the time stop closes it, releasing capital rather than letting the position drift indefinitely. Let's look at the actual MetaTrader code driving this. At the top, you can see the input parameters. MA period sets the moving average length used as fair value. Z threshold is the Z-score extreme we fade, defaulting to 2. RSI period and RsiLevel control the relative strength index and its oversold level, with overbought calculated as 100 minus that level. ATR period feeds the average true range used for sizing risk. Slope loopback and slope ATR factor define the flat regime gate. SlAtrMult and TpAtrMult set the stop and target distances. B-trigger ATR sets the break-even distance, and max bars in trade is the time stop. Now the buy block. The condition long signal is true when the Z-score is at or below the negative threshold, the relative strength index is below oversold, and the current close is above the previous close. When that's true, the code reads the ask price as entry, sets the stop loss 1.5 average true range below entry, sets the take profit 2 average true range above, and calls trade.buy with the fixed lot size. The sell block is the exact mirror. The condition short signal is true when the Z-score is at or above the positive threshold, the relative strength index is above overbought, and the current close is below the previous close. The code then reads the bid price as entry, places the stop loss above entry, the take profit below, and calls trade.sell. Notice how symmetrical the two sides are, and how every stop and target is expressed as a multiple of the average true range rather than a fixed number of pips. That's what lets the same logic adapt to different instruments and different volatility conditions. Now let's bring it all together on a chart and watch the strategy trade through a full cycle. Across the middle of the price, you can see the moving average, the line the strategy treats as fair value. Below the candles is the relative strength index, with its oversold level marked at 30 and its overbought level at 70. Watch how price stretches away from that mean line and then snaps back toward it, again and again. That elastic behavior is exactly what this strategy is built to read. Look at the opening candles. Price is hovering close to the mean line, roughly balanced, with the relative strength index sitting near the middle of its range. There's no stretch here, so the strategy simply waits. Nothing about this is extreme enough to act on. Then the selling begins. Over the next few candles, price slides steadily lower, pulling further and further below the mean line with each bar. As it drops, the Z-score is growing in magnitude on the downside, and in the panel below, the relative strength index is falling hard, sliding down through 30 into oversold territory. Price is now stretched well below fair value. Two of the strategy's conditions are lining up, the deep negative Z-score and the exhausted, oversold relative strength index. But notice the strategy still doesn't buy on that hardest falling candle. It's deliberately patient. It waits for proof that price is starting to turn. On the next candle, price closes higher than the previous close for the first time in the move. That's the reversal tick the strategy needs. Now all three conditions agree, and the buy entry marker appears. The stop loss is tucked below, a multiple of the average true range beneath the entry, and the take profit sits up toward the mean. From here, watch price revert. Candle by candle, it climbs back up off that stretched low, closing the gap toward the mean line, while the relative strength index recovers back toward the middle. As price reaches the take profit target near fair value, the long trade closes in profit for this illustration. That's the core idea in action. Enter when price is stretched and beginning to snap back, and exit as it returns toward the mean. Now the market does the opposite, and we get to see the short side. Price keeps pushing up past the mean and just keeps going, candle after candle, stretching further above fair value. This time the Z-score is climbing on the positive side, and in the panel below, the relative strength index is rising up through 70 into overbought territory. Price is now stretched well above the mean, and once again two conditions are in place: the extreme positive Z-score and the overbought relative strength index. And again, the strategy holds its patience. It waits for the turn. On the next candle, price finally closes lower than the previous close, the downside reversal tick. That completes the set, and the sell entry marker appears near the top of the move. The stop loss sits above the entry by a multiple of the average true range, and the take profit is projected back down toward the mean. Then the reversion plays out to the downside. Price rolls over and works its way back down toward the mean line, bar by bar, as the relative strength index eases back out of overbought. When price reaches the take profit target near fair value, The short trade closes for this example. So across this single chart, you've seen the complete symmetric cycle. A stretch below the mean faded with a buy, and a stretch above the mean faded with a sell, each confirmed by the relative strength index, each waiting for the reversal candle, and each targeting a return to fair value. That patient, rules-based structure is the whole personality of this strategy. That brings us to the end of our breakdown of Z-score mean reversion. Together, we've covered the statistical idea behind it, how the Z-score, moving average, and relative strength index combine to define a stretched and turning entry, how the flat regime filter keeps it inside ranges, and how the average true range stops, break even, and time stop manage each trade. Remember, everything here is for educational purposes only. It's an analysis of how a strategy is built, not financial advice, and not a recommendation to trade any particular way. Trading carries real risk, and losses are a normal part of it. If you found this useful, please like the video, leave a comment with a strategy you'd like to see next, and subscribe for more MetaTrader 5 breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.